Get the latest Zacks research, analysis, and rankings on exchange-traded funds in Exploring ETFs. We are going to learn what this recent upturn in manufacturing data means for at least a couple of ETFs with our ETF Research Director, Nina Mishra, who joins me right now. So the manufacturing data lately has been positive.
Yeah, it's been quite positive. In fact, ISM's manufacturing index rose for the 6th consecutive months to its highest level in 2.5 years.
Yep.
And market's PMI index also has been doing pretty well. It rose to its 10 months highest level in November. It's mainly because of this healing job market and higher consumer confidence that people demand more manufactured goods. So that is those are the reasons for the short-term uptrend in manufacturing.
So is this uptrend a reality?
Yes, looking at the longer term.
Is it here to stay?
Yeah, looking at the longer term, in fact, many analysts believe that US is on the verge of a manufacturing renaissance.
Really?
And there are three main reasons behind this trend. Lower energy prices. We all know that energy prices have been either stagnant to down. And the EIA expects that US oil production will top Saudi Arabia's by 2016. Wow. So energy prices will stay low in the coming years too. Then technology has been improving in manufacturing industry also. And lastly, wages in the US have remained stagnant because of low inflation, but the wages in developing countries have been going up, especially in China, because the inflation is much higher there. So the cost of manufacturing in developing countries, especially in China, has been going up. So it makes much more sense to shift some of the production work here. In fact, the manufacturing industry has added about 500,000 jobs in the last 3 years. And according to a journal report, over 90 billion of investments in manufacturing industries are being planned over the next few years. Not only in high-tech industries, but also in energy-sensitive industries like steel, aluminum, chemicals, because of the lower energy prices.
That's interesting.
And looking at the medium-term trend, industrials usually do well in a higher growth and rising interest rate scenario, which we are going to have in the next few months and which will be there to stay for some time. So I think it is time to invest in some of the industrial ETFs.
Okay, so you have a couple here that you want us to know more about. One is the iShares US Industrials ETF, IYJ the ticker.
Yes, this is one of the largest funds in this space. It has about 1.5 billion in assets, which are invested in 224 securities as of now. GE, United Technologies, and Boeing are among its top holdings. It charges an expense ratio of 45 basis points and pays a dividend at a yield of 1.25%. It has a Zacks rank of 2 or buy.
And the other is one by PowerShares.
Yeah, the ticker is PRN. This is a smaller fund, has just about 116 million in assets, but it follows a different index methodology, one of the advanced stock selection methodology. It selects companies on the basis of certain investment criteria like earnings momentum, price momentum, quality, and value. It holds only 60 securities, but it is pretty well diversified among those securities, with the top holding accounting for less than 3% of the asset base. Slightly expensive at 65 basis points expense ratio because of its advanced stock selection methodology, but this one has been doing very well compared to its peers. And this is also Zacks rank 2 buy ETF.
Okay, do you own either one?
I don't.
All right, we have a lot more ETF information and commentary in the ETF section of our website, Zacks.com, if you're not there already watching this video. Get on over, you can link to it right off the home page with Nina. I'm Terry Ruffalo.